Everybody, welcome. Oh, this is going to be so much fun. I hope you guys had fun on the 4th. We did a thank you week. So we shut down BGW and it was glorious. And I'm so grateful for that. I'm also grateful that we've got Warren Keene on here from Shoemaker and Jack Santinello's back in the seat. And Adam is up in our Hendersonville office. And we're thrilled to get into what are the, what in the heck is going on with this big, beautiful bill and how does it affect you as a business owner and privately held business? So I know that we want to get you teed up early in this conversation, Warren, because I think you're going to be talking about 1202 and some ramifications. Is that correct?
Yeah.
All right, cool. And then we'll get into some of our additional falderall, but I think we have a limited time with you if I'm not mistaken. So I wanted to jump into that. So anybody jumping on this, yes, if anybody got on late or gets on late, we will put it on the BGW YouTube channel as well as Shoemaker has theirs. But um, be kind to to Warren. We want him to come back. So be kind to him. Do not harass him on the chat. You can harass us on the chat. If you have questions, feel free to hit us in the Q&A. So Warren, well, Jack, you want to tee Warren up for us?
Yes, so absolutely. So Warren actually is a CPA. He was with Arthur Anderson, so we don't hold that against him because, I like hanging out with CPAs per hanging out with you guys every week, right? So he, worked in New York, so trained with, New Yorkers and then brought that down to Charlotte. He was with a large law firm here in Charlotte doing M&A work, private equity work. It's been over 10 years that I've had the benefit of having Warren as a friend, a partner, a mentor. He focuses on middle market companies and up joint ventures. He will tell you that he is not a fan of business corporations, that it's the world of LLCs and only LLCs. The reason being is partially because that, and Warren's too modest to say this, but as chair of the committee who basically rewrote the at the North Carolina LLC Act a few years ago. I think it was like 2014 or so ish, Warren, right? That as chair, you end up doing, and not to offend anybody that was on the committee, but as the chair, you end up doing most of the work, and because you want it you're done your way, but also because you want it done well, and the chair is responsible for that. So it's been a wonderful ride with Warren to be able to walk two doors down from my office and just ask him things that just, it's wonderful to be able to do that. And Warren is very generous with his time in teaching. So that's the general background. I could spend the entire time giving out accolades about Warren and how we feel about him and how we've been able to handcuff him to his desk despite him trying to get one foot out the door towards retirement or to the next chapter in life. But so far we've been able to hold on to him for a little while longer. But so there you go.
That's awesome.
Well, that's great. And it's been a wonderful experience working with Jack. He's been a fantastic partner. And thank you, Gary and Adam, as well, and everyone else out there for allowing me to join you today. I understand I only have about 10 minutes, so I'm going to jump right on in. But in following up with what Gary was saying, I don't have any problem with people harassing me. They've done it my entire life. So bring it on. Appreciate people should feel comfortable in sending me an email, calling me. Um, all that works just fine. And I'll be happy to respond. And I'm always anxious to learn, and you learn from people's different experiences and what they have to present to us. But my topic
Hey, Adam.
today is to make sure you all know that with proper advanced planning, there likely is a way for you to sell your businesses and your investment in businesses and pay little or no taxes.
Hey, Warren, can you, Adam has his hand up,
Yeah.
and
All right,
I see
go
him
ahead, Adam.
burning
I
in
didn't
his seat.
see.
Yeah, I'm
Oh,
trying,
okay.
well, so fun side note, usually I think everybody's an idiot and I don't listen to him, but Warren's not on that list. He's like, I always defer tax knowledge to this guy. So everybody listening, it's like that you that if I'm a black belt, like Warren's like eighth degree in the judo hall of fame with the stuff. So my only point in saying that is, hey man, I didn't know if Jack told you 10 minutes or that's your schedule constraint, but I've got a laundry list of questions on this specific topic if you can go over the 10 minutes.
I am here to spend as much time as you would
Okay,
like.
because
I just
like
want to be mindful.
I
I've
kind of
always
was
been.
settling in for the ride that this we might be spending about 30 minutes on 1202 because it's like there's so many scenarios that are so uncharted that I really would love for you to like. I've made commitments to people that are exploring this that the guru is going to be on. I know you can't make it, but I'm going to ask your question and see what Warren has to say about it.
Yeah.
I feel it's critical to not go over time. So I've limited this to about 10 minutes, and then I want all the questions you have. And my
Perfect.
10 minutes, there's no way you can cover this material in 10 minutes. My 10 minutes is going to be spent on just introducing the topic.
Perfect.
Should you be wasting or spending any of your brain cells thinking about this? Is it a worthwhile investment of your time and energy? And the answer to that is clearly yes. And so for 10 minutes, I'm going to explain why it is worth people's time and attention because it can result in millions of dollars of tax savings. Yes, millions of dollars in tax savings.
Yeah.
It is one of the few gold mines that exist in the Internal Revenue Code. I could spend days getting into the weeds. We can get in the weeds. That's what Adam and I will do later. But the most important thing is to get it on people's radar to ask more questions. And that's what we'll spend some time after I get through with this introduction. So what I was saying is that there is a way, again, with proper advanced planning, and that's critical, that you can sell your business for little or no tax. And this could mean millions of dollars in tax savings, $5 million or more. Money that would otherwise go to the government, you get to keep. Most people, though, are not familiar with these rules or don't fully understand them, but it is an area that I have worked in for 15 years because back during the Great Recession, the exclusion went from 50% to 100%. At 100% exclusion of tax, it becomes a real tool. First, let me start with something that I think most people are familiar with. As you all know, the tax law allows couples to exclude up to $500,000 of gain on the sale of their principal residence. If a couple buys a house for $500,000 and sells it for $1 million, there is no tax, even though the couple puts $1 million of cash in their pocket. If they sell the house for 1.1 million, then they only pay tax on the $100,000 excess. Assume a combined federal and state income capital gains tax rate, net investment income tax. That's that annoying 3.8% tax on investment income. Let's assume that combined rate is 30%. So you would pay tax of $30,000 on the 100, which is an effective rate of 5% on the $600,000 of gain. The policy behind the $500,000 exclusion is to promote home ownership. Similarly, the government has decided that they want to promote the investment in small businesses, which under the bill, the government defines as those having a gross asset value of $75 million or less after the investment is made. That covers most companies out there, and certainly most, if not all, startups or relatively young businesses. If one purchases stock in a qualified small business and sells that stock after 5 years, they get to exclude the greater of $15 million of gain. That's an increase from $10 million under the new law, or 10 times their investment. So assume I purchase stock in a qualified small business for $5 million. I get to exclude up to $50 million of gain from tax. That's simply math. 5 times 10, 5 million times 10, and 10 times one's investment is a pretty good return. Subject to a minimum exclusion of $15 million is even better. So if I invest little capital in the business and I sell my stock for $15 million, no tax. That's no income tax, no capital gains tax, no North Carolina tax, no net investment income tax, no minimum tax, no tax. This is per individual. So if Jack and I start a business and we put a little capital in it, Jack gets a minimum of a $15 million exclusion, and I get a minimum $15 million of exclusion, meaning that the business could be sold for a combined $30 million gain, and no taxes will need to be paid. If Adam joins us, we each own 1/3 of the business. That's another $15 million for a total of $40 million of gain that can be excluded from tax. And then there are ways to further what's called stacking or stack one's ownership through the use of trust to get multiple $15 million minimums. Another aspect of the new law is the government giving each child born between 2025 and 2028 $1,000 free money. Many of you, like me, likely are saying, that's great. I'm not planning to have any more children in the next 3 years. Likewise, you might be saying here, that's great for new businesses or investments that are made now or in the future in qualified small businesses, but I'm not planning to start a new business or invest in a qualified small business. I have enough on my plate right now in running my business. Is there anything you can do for me? Amazingly, the answer is probably yes. If your business is a limited liability company or other entity that is taxed as a flow-through, that is either as a partnership or an S corporation, then that business can convert to a C corporation and have that stock deemed to be newly issued stock for which the exclusion applies for future, I emphasize future appreciation. S corporations are more tricky, but can be done. So let me give you an example. Let's say you have a business that has a gross asset value of $15 million. And to simplify the illustration, no debt or a net equity value of $15 million as well. And assume the business is conducted as a flow-through. Let's say the tax basis in your ownership interest is $5 million for a built-in gain of $10 million. By converting to a C corporation, you are deemed to have purchased stock in the C corporation for that $15 million of value, giving you an exclusion amount of $150 million, 10 times the $15 million value. I think we all can see that is pretty incredible. The built-in gain of $10 million of tax is still subject to tax. I can't do anything about that. But all future appreciation is essentially excluded from tax. Say we sell the company more than 5 years later for $165 million. Only the $10 million of built-in gain is taxed for $3 million of tax on $160 million of gain for an effective combined tax rate of less than 2%. Wow. I can't do any better than that. So what are the qualifications in addition to the $75 million asset value threshold? First, there are businesses the government does not seem to like. They don't seem to like us. They don't like accountants, lawyers, doctors, engineers, and other professional service businesses, consultants, brokerage companies, entertainment, hospitality, finance and banking, real estate. There is a list. That is where a lot of people get misdirected. For most businesses that do not qualify, there often are parts of those businesses that do qualify. That is what I have done in many cases with existing flow-through entities, is put the qualified assets in a C corporation and leave the unqualified assets and the flow through. The qualified assets are the appreciating assets, the intangible assets, the goodwill, going concern, intellectual property. So when the combined company is sold, most of the purchase price is allocated to the stock in the C corporation, for which little or no tax is paid. Bottom line, there is the possibility for planning, even for companies that one initially would conclude they don't qualify. Lastly, what are the downsides and limitations? Biggest is what I call the deer hunter. It's one shot. It's only for the original buyer of the stock. It has to be newly issued stock from the corporation. So the stock that I buy in the corporation, I get the exclusion. If I sell my stock to Jack and Jack later sells that stock to Adam, Jack doesn't get the exclusion. It's one shot, one time, only I get the exclusion. And some say that buyers pay less when they buy stock in a C corporation than when they buy assets and can get a step up in basis. My experience has not borne that out. May be true in a minority of cases, but it's not true, at least to any material extent in my experience in most cases. It is limited to sales of stock in a C corporation. So the company must be a C corporation, and that's both good and bad. So if there is a need to make dividend distributions and therefore have two levels of tax, the earnings are taxed to the corporation, and then on the dividends are taxed when they are distributed to the owners. Those are the two levels of tax. Those companies are not the best candidates. The best candidates are growth companies. This gold mine is the product of the efforts of the venture capital industry and angel investors. They, along with serial entrepreneurs, make out like bandits under these rules, effectively allowing them to avoid having to pay any taxes. So if your plan, like most entrepreneurs, is to allow the company's earnings, is to plow those earnings into growth and paying down debt and sell the company, then you are the ideal candidate. This special treatment was specifically designed for you. And remember, the rate of corporate income tax, both federal and state, is substantially less than the individual rate that flow through entities have to pay, allowing more cash to remain in the company to be used for growth. Next, the caps. We have talked about the caps and how to increase those caps. Next, some businesses don't qualify. We have mentioned how that may not be an impediment, that we can work around that. Some businesses exceed the $75 million gross asset value. If an entity currently is taxed as a partnership, then we may be able to split that business into multiple companies to get under that threshold. Then there's the holding period, 5 years, which in the scheme of things is not that long. And then under the new law, they've effectively have reduced the holding period to as little as 3 years. If you hold your stock between 3 and 4 years, you get 50% of the exclusion. If you hold it between 4 and 5 years, you get 75% of the exclusion. If you hold it for more than 5 years, the exclusion is 100%. So what one can't do is come to Adam, Gary, or me in the year of the sale and ask us to reorganize the company at that time to take advantage of the exclusion. Can't do it. It has to be done far in advance, and the sooner it gets done, the better. The bottom line is that there is a lot of opportunity to substantially reduce or eliminate tax on gain on sale of one's interest in a business with the proper advanced planning. So those are my prepared remarks. And now I open the floor for any and all questions and harassment.
I love it.
And Adam is first in line.
Oh yeah, I did. And Jack, you may not get a question in. So I appreciate that overview, Warren. I think when so now we're going to get a little bit wonky for people. So I apologize if we lose a couple people here. So this is really just, hey, I need to get my questions answered. Um, you know, the trouble that I've had on this particular topic is the people that are claiming to be air quote experts in it. Um, and the I guess I'd be curious to get your take. The practical answer is that, hey, it's been around for a while, but nobody was doing anything with it until the Tax Cuts and Jobs Act changed,
Yep.
and the C corporation rates went lower. And it's by its nature, because there was a 5-year holding period, you really weren't going to see a whole lot of activity for realsies until 2022. So in terms of like, that's when we started seeing our first sales, you know?
Right.
So you get these people out here saying, well, you can't do this and you can't do this and you can't do this and you can't do this. But to your knowledge, has there been any court case yet that has involved Code Section 1202?
There have been one, and I forget the name of it, and it has to do with the qualification. The problem is just what you mentioned. We had the statute, and this was back in the day when Al Gore was busy inventing the internet. He also came up with this and said, we're going to do this for small businesses. But the problem was, as you recall at the time, that the exclusion was only 50%. And the part that wasn't excluded was subject to a higher rate of tax. At that time, the capital gains rate was 15%. The unexcluded part was subject to a tax at 28%. The excluded part was subject to an alternative minimum tax, which came out just a little less than 15%. So people said, what the hell? Why am I doing this when I don't have to? I get pretty much the same rate. That all changed in 2010 when they increased it to 100%, the exclusion to 100%. And then it became very, very real. As a result, there wasn't much activity. And usually it's when a statute has activity that the government gets on it and gets out regulations. We have a very ambiguous statute. So much so that in private letter rulings, they've had about our only guidance out there is they've had to go back and just use basic statutory construction. So we're not looking at any regulations or anything. We're going to rely on Webster's dictionary for the meaning of some of these words. So that's part of the reason is that there really has not been much in the way of guidance. These same types of concepts are also built in, as you know, in 199A, the qualified small business deduction. That's where we get some guidance. That's where they've got much more generous. And so where we used to be concerned or overly concerned, what is healthcare? Does it anything related to healthcare? Yeah. The rulings that have come out is no, you pretty much have to be a doctor. If you provide services to the healthcare industry, you provide software, and otherwise interact with the health code. That does not make you in healthcare. So they have really narrowed those things that limit those businesses which are excluded. And in addition to their definition of what a consulting business is. So there is guidance out there, mostly in the form of general counsel memoranda and in private letter rulings and one case.
Yeah, so I want to go back to 2016 when PwC told me that I was wrong about a pseudo healthcare company qualifying, and I want to say suck it. You know, I was right, you were wrong. But I guess where the question comes up, Warren, you know, you talked about, you know, because a lot of people don't have C corporations, so they're going to have to go through some conversion activity as if they want to take advantage of this, if they haven't started a C corporation. I think that where my general questions have come up with clients, and I'll give you a live example, and I'd be curious to get your take on it. You know, the company is a limited liability company that was taxed as an S corporation and then revoked its S election. So it's now in the eyes of the IRS, it's a C corporation at this point, and it has been for 7 years. and is about to go the route of an ESOP. So this is obviously very attractive, for this person. So you get all this. So they meet the TAC period, in terms of, hey, it's been longer than 5 years. They've been taxed in terms of they've been taxed as a C corporation, meet all the other tests. And you get people that hang their hats on like, yeah, but you didn't issue new stock certificates, at the time. So I think what's your take, especially given that this hasn't been challenged in a tax court for all intents and purposes around the holding period and somebody that elective form of taxation around like the reformation, the reformation work. If I was a partnership or I was an LLC.
Yeah, what you just described though is the real problem.
Hmm?
One, and people who know me, Jack knows me, I hate S corporations for a lot of reasons.
Yep.
S corporations are a mess. It is very easy for a partnership simply to convert to a C corporation, and it works like magic. It's newly issued stock. S corporations are a mess. S corporation, you've already issued stock. So all that you do is revoke the S election. You've done nothing to qualify that company for 1202. You're out of luck. The way you get there is through a very complicated F reorg, where you have to set up a subsidiary as a qualified subsidiary and then have the qualified subchapter S subsidiary terminate that election. That converts the Q sub into a corporation and is deemed to issue newly issued stock. That's what's magic here for purposes of 1202. You got to get newly issued stock. And so you have to go through those extra steps to get you to the promised land of newly issued stock in the case of S Corp. Very easy in the case of a partnership, more complicated in the case of an S Corp. But if you do it right, you start the clock at that point, not when you bought the interest in the LLC 20 years ago, 15 years ago, 5 years ago. It's when you do the conversion is when the stock is deemed issued, and that's when you start the 3, 4, and 5 year clock.
Yeah. So going back to a tip, because we're with you, like we listen to Warren's advice. We advise no one to set up an S corporation. It's always an LLC, and then we're just picking a form of taxation. So if I'm an LLC, and Warren did his thing. He drafted my operating agreement. I've got membership interest, and I just happen to be taxed as an S corporation. What do I do to make this work?
You have to do the F reward. So you will form a new S corp, have the existing company become a Q sub of the new S corp. At that point, and then we terminate the Q sub election. That causes it to become a C corporation and is deemed to have issued stock to the S corporation. S corporation and a partnership can own an interest in a qualified small business, and they just look through. Corporations don't get this benefit, only individuals, directly or indirectly. So if you're GM, you cannot set up a company and get this benefit. It's only for individuals, whether those individuals own that stock directly or indirectly through an S corp or a partnership. And so that's what you would do. You got to keep that S corp around. And like most of these structures involving S corps, because there is the inability to make distributions of appreciated property tax-free as you can with partnerships. You have what I call zombie S corps. We got to keep it around to avoid the trigger of the built-in gain until there's cash to pay the tax. So the S corporation continues to own. You still have an S corporation. The owners own their interest in this new S corporation that then owns the C corporation, and then the S corporation will sell the stock in the C corporation to get this benefit. Yeah, and that's the structure that you have to put in place when you deal with S corps.
The only tax being what would have been the tax in the deemed liquidation of the S corporation. that built-in
The
gain.
built-in gain,
Yeah,
exactly.
I got
That
it.
built-in gain we can't fix. But the benefit of that, as I mentioned, is that you'll get a higher exclusion under the 10 times test. Because
Yeah.
at that time, the companies become more mature, and I've done this for a number of companies. And then we're above the $15 million minimum. In the example that I gave, I assumed that the company value was 15 million, giving me an exclusion of 150 million.
Yeah,
That's huge.
unbelievable. Yeah, unbelievable. How about in the I guess if I'm looking to do like the spousal kid ownership piece to really ratchet up my exclusion amount like we were talking about, I've got some gifting considerations, not maybe not on the spousal transfer piece, but in terms of my kids, like what are you thinking in terms of like, okay, if I'm gonna do this and I want my kids to be part of the benefit stream, when do I need to be thinking about making that gift, and what valuation, am I using?
Well, for all valuations, particularly for an existing business,
Mhm.
you want to get an appraisal because you have the built-in gain. You want to establish the value for purposes of computing your 10 times investment cap. You also want to establish the value, determining the amount of the built-in gain, and you want to have that in your file as to what that number is and how do you justify it. So that's critical whenever you're taking an existing business that's in a flow through and converting it into a C corporation. You got to get an appraisal to put in the books. And then as far as gifts, you definitely want to do any type of gifting around when it's still a flow through, because the gifts are one of the few things that can be done under 1202. 1202 is extremely sensitive. It is one of the reasons why people may shy away from it. It does require a fair amount of maintenance and attention, because if you blow the active conduct of business, if you blow what you're doing at any time during the course of its existence, and then you risk the the benefit that you're looking for. So for that, and that includes the original issue stock, that applies even to some forms of transfers, of tax-free transfers. It's a very limited list of transfers that can be made in which the transferee steps in the shoes of the transferors. And the only list is bequests at death, gifts, and transfers of interest by a partnership to the partners. So under those rules, if one contributes 1202 stock to a partnership tax-free, the partnership doesn't get the benefit. It's only when it goes the other way. So a lot of care has to be given to those transfers. In your case, if you have 1202 stock and you transfer it to your child, then he just steps into your shoes, and the two of you are treated the same. So you would want to have done that transfer while it was still a flow through, so that he exchanged your donee exchanged his or her shares, or his or her interest in the flow through, for stock, for deemed stock in the C corporation.
Yeah, got it. Yeah, this is awesome and game-changing stuff. I think last question I've got that's a little bit related to Matt's question that he posted in the chat, is that, Matt, I know Matt's business well enough to say your business would currently qualify based on how Warren just described. Your problem is the S corporation piece. But in general, the talking heads at Shoemaker got together and said, "Hey, we really like this, and we got a deal on the table to buy the firm." And Warren says, "Oh my gosh, we're a law firm. We're considered a specialized service business. We're not going to qualify, blah blah." Like, what would be typical examples of things that you could carve out in a CPA firm or a law firm or a doctor's office that you think, yeah, I can make a case for that and make it qualify?
Yeah, professional services are the most difficult. So I've never done one with professional services, but I know in the private equity world, they cannot be doctors, lawyers, accountants, because they aren't qualified and they can't as to certain components of it. Certainly, you don't want a private um, or private investment um, finance person doing your brain surgery. So they're not allowed to. So what they do is they set up a management company, and the management company provides all the back office stuff that is vital to the continued operations of the business. And they have a services agreement, intercompany service agreement with the professional service company. And effectively, that contract sucks out all the value. So that you would use something analogous to the roll-ups that have been undertaken for dentists, certain doctors, accountants, and other professional services that were originally thought untouchable by private equity. That private equity has found a way to come in and acquire those companies through these management company structure. Another example that I have utilized in a number of cases deal with home builders. Home builders deal with real estate, right? On the surface, on the face of it, you don't qualify. Sorry, we'll have lunch someday. No. What is a home builder? A home builder is a manufacturer, right? They make houses. All right. So I have to accept that there is an unqualified piece of this, the purchase and sell of real estate, the dirt and then the house. The key is to embrace the unqualified part and put that in a flow through and say, we acknowledge that a part of this business is not qualified and we're not trying to qualify. We'll put that separately in the flow through and that works. So all of the purchase of real estate, the land inventory is held by the flow through that then contracts with the general contractor C corporation to build the house. Again, you have that intercompany services agreement, and that allows you to some extent to regulate the cash between the two. Excess cash can stay in the flow through. That can be distributed out for your cash flow needs to your owner. So that becomes a very exquisite structure to allow cash flow to go out on operating income, but all of the appreciating assets, the personnel, the business, the goodwill, the intellectual property, all of that is in the C corporation. So when you sell the combined company, the lion's share of the purchase price will be allocated to the C corporation stock and not to the flow through.
Yeah. I love hearing this stuff. I drive an electric vehicle, and I'm gonna say it, it's less so because I care about the environment, although I do care about the environment. It's that I love sticking it to the man when I drive by the gas pump. So I always feel like with this particular, the stuff you're describing, like I love the sticking it to the man. Element of all this. So thank you, Warren. I've monopolized enough of the talking.
Yeah, this is really good stuff. Very esoteric in some ways. I mean, and not everybody does it apply to, as Warren has eloquently described, but for those that it could, it's a game changer as long as you've got the patience, right? And even if you have opportunity knocking before that 5-year time frame's up, if you can make it to 3, you still get a pretty incredible blessing. What I'd love to do is hear from you guys, anybody that's on this call, any additional questions you got for Warren, number one. Number two is any additional questions you have regarding the big, beautiful bill and tax implications for you, so R&D, depreciation, those kind of things that have that, even 2 years ago, we were going, hey guys, you might be wanting to get ready because things could be changing because we didn't know what was going to be coming down the pike. We just knew that the Tax Cuts and Jobs Act was set to expire this year. So while we're waiting for any thoughts on that, Adam, Warren, Jack, you want to weigh in on kind of low hanging fruit stuff that people should be aware of that they could be planning for right now or addressing?
Well, I want to put
That
a
would be
little
great.
asterisk to on the professional service provider companies that you also need to consider what can be extracted or what is required to be extracted when you're setting that up and having the professional services provide the professional services. So, you have to have a doctor providing the services too, and it may be that the C Corp owns the building, it hires all the non-medical personnel, it deals with all those logistical issues. And so, that also is an important planning part of doing this process with a professional services company that might otherwise be excluded from 1202 if it's all in one place.
Yeah, I think, thank you, Jack. I appreciate that. I think a lot of the stuff in the bill was relatively straightforward, in terms of, hey, an extension of what already existed. I think probably the one that, it's not that it's a take advantage of it or don't take advantage of it. It's more of a, um, well, actually, I'll talk about one to take advantage of, and then I'll talk about one that, hey, you'll probably ask a question about because you heard of it. The state and local tax deduction, um, that was effectively kneecapped in the 2017 Tax Cuts and Jobs Act by saying, hey, that's interesting. You pay state taxes. You used to get a deduction for that. Now we're effectively capping it to where it's worthless. Well, the states helped business owners as a way of getting around that by allowing for what was called the pass-through entity tax deduction, which allowed you to pay your taxes through your company for a flow-through entity and then get a deduction for it at a federal level, because at the federal level you get to deduct state taxes at the company level. So my point in saying all that is, even though that raised a limit, for most of our clients, that isn't going to make a difference anyway, with the exception of on the ability to deduct real estate taxes if your real estate taxes are excessive. I'd love to have that big of a real estate tax problem. I don't. So, for most of our clients, it's going to be a non-issue unless your W-2 is pretty significant. But if you're taking most of your income through K1 through a distribution or a ordinary box one ordinary income in a partnership, it's not going to make a huge difference for you if you were wondering. To take advantage of is that, remember, this is the part where I disavow Shoemaker from any legal liability or lawsuit, is that, we perhaps told people that really wanted to be aggressive with the research and development tax credit in the past, that maybe their definition of research and development really was just solving their own internal problem that nobody else had, and maybe it was really more, fixing a break versus true research, because the deductions sucked. Meaning it was fine, but basically it was a very delayed gratification. They fixed all that now, so it's become a more attractive option if you're really going to dig in and say, hey, do we really have any real research going on around here? Because the definition of research, is actually fairly broad, in terms of what actually can qualify.
I guess what I would put to the top of the list of what people should be thinking about, given the turbulence, some call chaos that exists in Washington right now with the tariffs and all, is
Yeah.
that they not only have extended, but I think they've also expanded the ability to expense um, purchases of machinery and the like. And so I would, if I was a business owner, that's what I would focus on for two reasons. One, if I can expense this, that's a great deal instead of having to capitalize it and depreciate over time, so I can get a huge deduction. Two, speaking as a consumer, I've done this for a couple of purchases because I was concerned that the products that I were buying, some paddle boards and some bikes, were coming from China, and I wanted to get that in before they were hit with tariffs, and the pricing is going to go up. So I think that combination of the price likely going up and being able to expense it is something that, if I was in business, that's what I would consider. And then there is the fun side of things, is there are a lot of changes, and I don't practice in this area of estate planning and gift planning, but I live in this area, and I fired off an email to my daughter, who's the mother of my grandchildren, and said, we got to do something about these Trump accounts and set up some Trump accounts and other things. So there's a lot in the estate planning area as well to consider, which I kind of put on the fun side for allowing for opportunities to get it with your family, and uh, presumably all in good spirits, because you're talking about giving them some of your wealth. So that's something that I would encourage people to look at, to visit with their financial planners and the like, to see if there are some of these tax-free accounts they want to take advantage of.
So a couple questions that have come in. One ties into what you talked about there, Warren, was from Papa Joe Farrell. When is the amount of the tariff determined? We have product coming in from South Korea. Is the tariff in place when it ships, or is it the tariff in place when it arrives via ocean freight?
So I don't know if we know the answer. Warren, do you know the answer on the tariff, the point
No,
of,
I,
yeah,
I, I have not studied the tariff rules.
yeah.
I
I
believe,
don't know this, I'm making this up, but I think it's at the point of when it arrives, and then there's some due diligence that's done on it as to the origin. And then it is, okay, you're not getting through the gate until certain things happen, like, okay, paying the tariff in addition to, to basically safe passage through that big metal gate that I imagine exists in those warehouses. But again, that's Jack theory. But Adam gave me a thumbs up, so
yeah,
maybe it's correct.
that's a true statement. And I think what a lot of our clients have done that have been faced with this poop fest is that they've spit, because basically you're self-reporting what, in other words, they're going to get you, but you're self-reporting the country of origin in some respects. So what a lot of our clients have done is to say, okay, look, this may have come from China, but the component parts came from blah 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 blah, such that, in other words, if I've got a thing, I'm breaking down the thing into separate discrete component origin points, to where the blended tariff rate ends up being a little bit less, because arguably and legitimately, a lot of the elements came from a lower tariff jurisdiction. But I mean, you are getting hit by a bill when you take shipment on the thing. So and you gotta, it's like, do now. Like, that's not like one of the cool things that Warren and I would talk about. Well, I mean, the whole thing with taxes is like, you're just buying time. The bill's not actually due today. This bill is due today. Which sucks if you weren't planning for it.
Yeah, and there's examples out there, and I think I put one up probably maybe a month ago or 2 months ago. We were talking about tariffs directly as the topic, that showed it was a component, and I don't remember what it was, but it showed the elements of it and what it was, what the cost was for each of those components, what the tariff was, and then what the total cost was prior to tariffs, and then what the total blended tariff would cost to get that item through that gate. And so there's examples out there, I assume for different industries, different types of products, that on, Google that or Chat GPT it, you'll probably find it.
So we've got another question from Matt, and this is directed to you, Warren. Have you written or are there any narratives on the QSBS section 1202 worth reviewing? Tell me more about the value of research deduction.
Value of research deduction. Is that 1202 or is the
No, the R&D.
seem two different questions?
Yeah, the
two
R&D
questions.
credit's a section, different question. So I think
I'm not the R&D. I would get on the phone and call Adam and Gary to answer questions.
Call Adam. I'm just Ed McMahon.
So Adam, you have the floor to talk about
yeah, I can't speak to if you wrote anything or not, but the on the
I
R&D,
can assure you, I've written nothing on research and development.
yeah, no, on 1202 on the
I
research
have that.
Yeah, on the research and development credit, I mean, basically, if you pass a test in terms of qualified research, you have the ability to not only deduct the expense, but then also get a credit for it, which is the way that it used to be. But before this, what it used to do in the tax cuts in the 2017 Tax Cuts and Jobs Act is you had to capitalize it. So you got a tax credit, but you couldn't take the deduction. You had to take the deduction over time. So it just became a very delayed gratification. All that said, it's still a labor related credit. So I mean, like, you had to spend some money on belly buttons to get it. It can't be like Adam wrote a brilliant piece of thought leadership, and his time is worth $1,000 an hour. What's my credit? It doesn't work that way. The way that it would really work would be, Adam in his brilliance did something innovative. How much time did he spend doing that? And that subset of my cost is what's evaluated for the purpose of the credit.
So, Warren, regarding your 1202 dissertations, where could Matt and company find more of what you've written about 1202?
Probably online in my old firm. Well, what I did.
No, wrong answer. Wrong answer.
That was back in 2010, and I had a standard line with regard to entity selection, and I would have a new business, new client, and I'll let them know, look, I'm as capable of the next guy of making a mistake. So I'm going to put you into a partnership, into an entity tax partnership. That may be the wrong decision. If it's the wrong decision, I can fix that. It's easy. I can convert to a C corporation or an S corporation real easy without tax. I can't do that if I'm a C corporation or an S corporation. I can't go from a corporation to a partnership without paying 1 or 2 levels of tax. And I always felt good with that presentation, with that answer to folks. And then it came home in spades when they increased the exclusion with 1202, because what they did originally, they gave you 3 months and only 3 months between September of 2000 and December of 2000 to get the 100% exclusion. As of January 1 of 2001, it was scheduled to go back to 50%. Now, who can make an investment, make that type of decision within 3 months? Almost nobody, except for those venture capitalists in California who had things teed up. But yeah, you could convert partnerships. It established the soundness of my device of staying flexible, and partnerships allow you to be extremely flexible. So in that 3-month period, I converted a number of partnerships into C corporation because I could do that within 3 months. And then at the expiration of that, they extended it for a year and they extended it for another year and they finally went permanent. Um, it was at that time, because I was doing it, all of a sudden 1202 became a real consideration. I wrote a number of articles way back then, so they're somewhat dated. You can just Google 1202 and you will have a massive amount of materials available to you. Some are better than others. Mostly you're limited to what is in the statute. And it's one of those things I would suggest that it's good to get that background, but the devil is in the details as to your specific situation. And if it's something you want to consider, it's well worth the investment to get some professional guidance to kind of work through. It's what I frequently refer to as go buy an hour. That was something that my mentor told me on areas of the law that I wasn't familiar with. I would buy an hour of time, kind of a discrete segment to just have a consultation. It may go beyond that, or it may be limited to that, but at least you would have that answer. There's a lot of material out there for you to get a general understanding, but as to the specifics, I encourage you that you speak with a professional who deals in this area on a regular basis to go through the pros and cons of doing any type of adjustment for your business.
That was the long way of saying it depends, because we say that a lot when we're in this program. So it depends on your circumstances.
Yeah. Yeah. And Matt says, thank you very much. Yeah, this has been really good, man. Warren, now I understand why Jack was ooshing and gushing over you, because you are a sage, man. So thank you so much for taking time out of your day to shed some incredible light on this one. Um, we may still need to peel back the onion a little bit more into the big, beautiful bill. I haven't read all 1,000 pages of it. I don't think that anybody that voted for it read all the 1,000 pages on it. But all I know is I want to dig in deeper into what does it mean as far as the stuff that affects you and me as business owners, and from a tax standpoint. That's especially what I'm very interested in. So I think we need to peel the onion a little bit more. And I know Adam will probably want to get real wonky on more of that stuff too. But we've really tried to keep this speaking English and versus, governmental sanitized talking points that nobody can understand. So, any last, oh, here we got another question that has just come in. Let's see. No, never mind. I just didn't clear it out. Anything else before we say sayonara?
I want to thank Warren for coming on, and I agree that there is a lot more we can talk about. I mean, we just really focused on 1202 because it should require a lot of focus, and I think it's a wonderful opportunity for those that have been thinking about, okay, how can I not pay as much taxes? But there's a pathway to do that properly. But there's also the the other stuff there's a whole laundry list of things we could talk about. So maybe we do need to have a 2.0 or part two sometime in the near future, maybe even next week. So
Yeah. Yep. All right, cool. Warren, thank you so much.
Well, I thank you all for inviting me. I've enjoyed this time to talk about some stuff that usually only I care about. Hopefully, others care.
Well, anybody that's listening that is running a business should be caring about it, because it could mean some big money in your pocket, and that's not going into Uncle Sam's pocket. All right. So again, anybody that came on late, we will put these up on the BGW and Shoemaker YouTube sites respectively later on this afternoon. I would definitely reference it and feel free to forward it to somebody that's wondering. So anyway, we'll catch you next week, Lord willing, for week 263. Again, Warren, thank you. Adam, good seeing you. And Jack, thank you again.
All right. See you guys.
Thank
Thanks,
you.
Have a
guys.
wonderful day, y'all. Bye bye.
Goodbye.
Bye now.